Hello, everyone. Hello, welcome. Thank you for joining us today. We are going to get started in just a few minutes. I want to do a couple of housekeeping items here. Please feel free to use the chat feature to let us know where you're joining from. And as a reminder, if you have any questions for our speaker today, you will need to submit those through the Q&A feature, which is down at the bottom of Zoom there. This is going to be the best way for you to interact with them.
Thank you, Matt.
And then we will get started here in just a minute. Seeing a couple people trickling in here. And yeah, feel free to let us know where you're joining from. All right, I think we're going to go ahead and get started. So thank you everyone for joining us for this presentation on financing your graduate degree presented by our partner Juno. This session is going to cover the real costs of graduate school, how to manage your finances, and how to pay for it. If you're interested in learning more about Juno, you can find out about them on our website under the member benefits section. It's my pleasure to introduce Diego Aragon. He is the head of graduate students at Juno. They're a collective bargaining platform for graduate students, graduate student loan financing. Before joining Juno in 2021, he advised Mexico City's largest corporations on capital market strategy. Originally, he's from Mexico City. He earned his MBA from the University of Chicago Booth School of Business and holds a BA in economics. Please welcome Diego to the virtual stage.
Hey, everyone. Thank you, Matt, for that great introduction. Great to be here with you today. Thank you for having us. Yeah, let's just jump right into it. As Matt was saying, today we're going to touch base on financing your grad degree. Okay. This session is aimed for US citizens, US permanent residents, or international students with a US cosigner. If anyone in the audience is an international student who doesn't have a US cosigner, please stick around. There's still going to be very valuable information for you. And if you have any questions specific about an international student financing a grad degree, feel free to send us a note at this email, which I'm posting in the chat right now. As Matt was saying, please make sure to use the Q&A feature for whenever you have any questions. I'll try to make a quick stop every couple of slides just to make sure I'm not missing any questions related to that specific section. But then at the end, we'll have roughly 15 minutes for open Q&A. So with that, first things first, quick disclaimer, nor me or Juno, we're not financial advisors, investment advisors, security brokers, or any type of advisor. So none of the information offered here today is an investment advice or financial advice. Okay, so agenda. I'll do a quick intro about the company, and then we'll dive right into budgeting for grad school. Then we'll take a deep dive into student loans, how they work, both federal and private. And then at the end, I'll like to introduce what Juno has done this year for students heading to grad school this coming fall. As I was saying, at the end, we'll leave some time for open Q&A. So I guess I'll go very quickly through this one because Matt already introduced me. So Diego here from Mexico City. I currently lead the grad students efforts here at Juno. Have over 6 years of experience doing investment banking and fintech. And as Matt was saying, I hold an MBA from Chicago Booth School of Business. So what is Juno? Juno actually started as an experiment a few years ago as our two co-founders were heading to business school. They were trying to get a loan for themselves to pay for business school. But they realized that the rates they were getting for their loans seemed a little bit high. So Nikhil here, one of our co-founders, you'll see some of the screenshots he originally posted in his Facebook group. Notice there was some initiative overseas that where they were kind of bargaining with lenders to get a bulk discount on behalf of a group. So basically, he just start cold calling some lenders, some bankers, try to get a discount for himself and a few of his classmates. Long story short, one of these lenders told him and Chris, our co-founder, that if they brought with them, a few of their friends and classmates of their and peers, they will give them like a group discount. Long story short, that ended up being a successful negotiation where everyone in the group ended up saving roughly $13,000 worth of interest. And yeah, it was a very successful negotiation. That was the first one. This was back in 2018. Since then, we've been doing this every year where we group together as many students as possible and we try to negotiate a discount on behalf of students. We've been able to work with a lot of grad students across the top MBA programs and top grad programs in the US. And we recently surpassed $1 billion worth of student loans that we've been able to negotiate. So very roughly, how does Juno work? So think of yourself as a borrower, like an individual borrower. Before Juno, you will be shopping around individually with each lender, right? So you go to lender A, get a quote, lender B, get a quote, lender C, get a quote, compare, go with the cheapest one. With Juno, what we try to do is we try to do that shopping around for you. So we group you together and we go to all these lenders and shop around as a group. In exchange, we ask for a discount or a benefit to any of these lenders on behalf of the group, right? It's important to note that Juno has always been free and it's always going to be free for students. And we don't make our money from the students, we make our money from the lenders. And honestly, the students are always better off going via Juno than going directly to the borrower. And I want to make a very clear point here that I'm referring to the private market, not the federal loans, okay? We'll touch base on federal and private in just a few moments, but this is generally how Juno works. We'll touch a little bit more on Juno's latest negotiation at the end of the presentation for anyone who, if anyone has any questions. All right, so jumping right into our first topic of the night, budgeting for grad school. All right, so schools sometimes, and I'm underlying sometimes, underestimate the median cost of attendance, okay? So cost of attendance is a term that I'm going to be using throughout the presentation. Very important for you to remember. Cost of attendance is a number given to you by your school that says it's an estimation of how much how much your degree will cost for that immediate academic year, right? So cost of attendance includes two things. One, tuition and fees, and two, an estimation of your living expenses. Now, over the years, and this is especially true for MBA students, we've noticed that people tend to spend more than what the school tells them it's going to cost, okay? Now, it's not true for everyone, obviously, but in many cases, we've noticed that happens. So what do we recommend? The first thing is to start doing a budget, okay? So a budget has to be very simple, right? You estimate your expenses for school. You estimate how much funds you'll have available at the time you get to school. You estimate your earnings during school. Remember that in many programs there are internships, right, where you earn some money, between your first, second year, third year, depends on the degree. And then after that, you estimate how much loans you'll need. Now, one thing that I like to emphasize here is that we recommend, if you have the luxury of having some savings as you head into business school or grad school, I should say, we recommend doing like an emergency fund. And I'll give my own experience. When I was heading to business school, I went with my wife and I calculated 6 months worth of my cost of living. I had savings, right? So I set aside 6 months worth of cost of living into a savings account. And actually, I haven't touched that into this day. Okay. Now, why did I do that? You don't know to what job market you're going to be graduating, right? So In many cases, and I've seen this firsthand, you graduate between May and June, and probably a job offer is going to come in hopefully before you graduate, but the start date is going to be until August, September, in some cases even January next year, right? So you need some funds to kind of fund yourself between the time you graduate and the time you start working, right? So the point here is do not plan to go broke as when you're graduating. Okay. I have a link here that I'm going to paste on the chat that people can use for free. It's a link we have available for everyone. And you can start from building your budget from there. Okay. Right now, right in this slide, I have like a screenshot of an estimate I did, right? Now, I'm not going to get into the details, but the key points here to consider are, for example, moving expenses, right? People usually tend to forget that you need to pay, like if you're going to grad school in a different city where you're living right now, then you're going to have to pay moving expenses, right? So that's moving expenses on your way in. Now, if you're graduating into a job which is in a different city, you have to pay another moving expenses. Now, another thing to consider is that usually the cost of attendance issued by your school is an estimation for 9 months, right? So say you're going to school in August, right? Those 9 months will take you roughly by May. So then how about, what about the summer, right? You still need to live, right? For example, if you're signing a lease, usually grad students will not live on campus, right? Usually leases go for 12 months, right? So you need to plan ahead for that, okay? So this link I just posted is going to give you a very good start on how to plan for these little things, right? And there's obviously things like dining out, trips. In many grad schools, you need to pay club memberships, right? If you're planning to join a club. So plan for all of that, right? As I was saying, plan for the income you're gonna get through grad school. Plan, I guess, forecast the savings you'll get by the time you join school, and then based off on that, you'll realize your delta, right? How much it's gonna cost you, how much you think you'll earn, how much you have, setting aside that, hopefully that emergency fund, and then that's how you realize how much you need. Okay. Now, there's many students that come to us and ask the question, I have some cash, right? Should I use that to pay for school, or should I just keep it on my pocket, right? So let's assume that someone's debating on using $30,000 worth of cash that they have saved, right? Let's say that the loan rate they're getting is 7.5%, which is something we're seeing these days. There are high yield savings account out there that are going to pay you 4%. So that means that in reality, the cost of funding $30,000 via loan is 3.5%, right? Let's assume you're going to a 2-year program, say business school. That's usually 21 months, right? That means you're paying roughly $1,800 worth of interest, right? Now, $1,800 is not nothing, but what is that giving you? That's giving you the optionality of having that $30,000 in your pocket, right? As I'm saying on this slide, cash provides optionality, right? And again, don't plan to go broke at graduation, okay? So this is the main message. Second most common question we get about personal finances is, what happens if I have like a stock portfolio that I could use to pay? It says B school here, it should say grad school. But the point here is that depends, right? Now, every stock portfolio is different, right? You might be aggressive, you might have your investments or your assets in some illiquid portfolio or more liquid portfolio. No matter what, let's assume that I would say like a low risk stock portfolio historically returns between 7 and 10%, right? So if you want to use that to pay for school, then you're kind of not earning that 7 and 10%, right? 7 to 10%. Moreover, if you sell like equities, you're probably going to be trigger some taxable event, right? So my point here is optimize for who's offering you the lowest cost of funds, right? And as it says here, right, you should consider the quoted interest rate you have from any lender, right, and compare it to your investment options and then make a decision from there. All right, I'll make a quick stop here to see if there are any questions. Okay, sounds like I was pretty clear on this section. I'm gonna move into student loans. Okay, let's start with this. So student loans usually happen, and I mean happen like people apply to them during the summer, right? So saying people usually determine how much they want to borrow, determine where you want to borrow from. We'll get to that in a few slides, and then just complete the process, right? So usually, people or students enroll on their programs in the fall. So, June, July, August. Actually, right now we're in the midst of what we call peak season, right? People are getting their loans. Now, student loans are tied to your cost of attendance. Okay, your cost of attendance is given to you by your school once every academic year. Okay, so if you need a loan for your first year of grad school, you'd apply on the summer before your first year. If you need a loan for your second year of grad school, you would be applying for a loan of the summer before your second year of grad school. Okay, that's usually how it works. Now, that doesn't mean that if you didn't apply during the summer, you don't get the chance to apply. You can always apply for a loan at any point in your academic year, right? So if anyone has any specific questions about that, please shoot us a note, and I'll be happy to assist you with those specific situations. But the point here is that yes, you can apply for a loan at any point in time, as long as you have some cost of attendance left, right? So the rationale here is that, let's say if your cost of attendance is $100,000 for your first year, and let's say you're in the middle of the year, that means that your cost of attendance now has gone down to $50,000, right? Because technically you've already paid for half of your school year, right? Where you already paid tuition and your living expenses. So your cost of attendance kind of decreases as your academic year progresses, right? So that's the rationale here. Okay, as I was saying a few moments ago, the cost of attendance is a maximum loan amount you can borrow, okay? Again, the cost of attendance includes tuition and fees, and then an estimation of your living expenses. Okay, that estimation is done by your school. Okay, living expenses are things like rent, food, transportation, books, laptop, things you need to attend school, right? Now, let's go back to that example. Let's say that your cost of attendance for your first year of grad school is $100,000. And let's say you're getting a scholarship of $20,000. Then that means that the maximum amount you can borrow would be $80,000, right? Again, that's per academic year. Now, there are some situations in which people need to borrow more than that, okay? Now, those situations, they have to be like valid, right? It's like, think of if you're going with a partner, a spouse, or a dependent to grad school, then that's a good reason for your school to increase your cost of attendance, right? If you tell your school that you need more because you want to go on a trip, then that would not cut it, okay? But the cost of attendance is going to be determined by your school. Okay, so any lender you borrow from, at the end of that process, is going to certify that the amount you're applying for is within that cost of attendance limit. Okay, awesome. All right, so what are your student loan options for this year, 2025? And I'll make a note, I'm saying 2025, okay? Because if someone out there, someone in the audience is familiar with what's going on with the bill that was recently passed by Congress and signed by law by the president, next year, this chart is gonna look different, okay? So 2025, as a US citizen or a US permanent resident, you have two options, federal government and private market, right? On the federal government, these are the column number 2 and 3 on this chart. You have two options. Option number 1 will be the federal unsubsidized loan option, also known as a direct loan, where you can borrow up to $20,500. The interest rate for this year for that loan is 7.94%. There's an origination fee of roughly 1%, and then you get the benefits of public service loan forgiveness and income-driven repayment plans. I'll touch base on that in just a minute. The second option on the federal side is the well-known federal Grad Plus. Okay, the federal Grad Plus allows you to borrow up to your cost of attendance, right? But it comes with a higher rate of roughly 9%. Okay, it's 8.94%. Now, on top of that, they're charging you an origination fee of 4.23%. Okay, that to me is an expensive fee. Of course, that loan option also comes with the benefit of public service loan forgiveness or income-driven repayment plans. Okay, now on the private side, usually you can also borrow up to the cost of attendance, but the rates will depend on your credit worthiness. Okay, now there are many different lenders out there, but here at Juno, we try to make sure that everyone's receiving a rate at least below the Grad Plus option. Okay, but at the end of the day, it all depends on the borrower's credit worthiness. Now, on the private side, we typically don't see any origination fees. Okay, at least the ones we work with here at Juno. But at the same time, you don't get those benefits that the federal government offers, right? Which is the public service loan forgiveness and the income-driven repayment plans. Now, probably a few of you are asking yourself, what is public service loan forgiveness? What is income-driven repayment plan? So basically, those two features from the federal government loans allow you to, your loan will be forgiven after 10 years of public service. And you can also get the benefit of fixing your monthly payment for your loan after school at a fixed amount based on your, I guess I should say, as a percentage of your discretionary income. Okay, that's not offered by private lenders, as far as we know. Okay, so if you're going for grad school and you're considering public service or a career where, think of a nonprofit where you're not going to be earning, 6-figure salaries or something like that, then consider public service and or income-driven repayment plans. Okay, but if you don't think you're going to need any of those two benefits, then my recommendation is to optimize based on cost, right? Which of these three options is offering you the lowest cost of funds, right? It could be the private sector. It could be between the unsubsidized and the Grad Plus, or it can be only a federal, right? Again, it depends on your credit worthiness. I think we already touched base on this slide, so I'll just skip through it. As I was mentioning, there's some origination fees that you see on the federal options. Now, I like to make this point here because that origination fee effectively means that you'll get an APR of roughly 10%, right? That is if you don't refinance your federal loan, Grad Plus loan, as soon as you graduate, which is very common for grad students, right? Very typical to see grad students, especially MBA students, to refinance their loans right after graduation. So think of it, if you're refinancing a Grad Plus loan right after graduation, then you're effectively increasing your APR to roughly these two numbers that you see here, right? So let's say you took a Grad Plus this year and you're refinancing next year, right, 2026, the APR is going to look a little bit like 13%, okay? And if you refinance that in 2027, the APR is going to be like roughly 11%. Okay, so basically that means that it's costing more than the 8% or 9% interest rate that you were seeing up there because of the origination fee. Let me just check if there's any questions. Okay, I don't see any questions. As I was saying, like the rates through Juno will basically nearly always be lower than the federal Grad Plus, right? Even for borrowers with less than 700 credit scores, we tend to beat the Grad Plus. But yeah, generally speaking, I think 98% of Juno members see rates below Grad Plus. Okay, I cannot emphasize enough for whenever you're shopping around, compare your options, right? So go to this link here, johnjuno.com/calculator/Fed versus private or Fed versus REIT. And you'll get to this page. There's a screenshot of it in this slide and compare your options, right? Play around with it. You'll get a quote from, you can do it on the Juno website, a quote from a private lender and compare your options, right? And see for yourself the actual cost of going one versus the other. Okay. Okay, so I'm gonna someone's asking a question. So can I get a loan if I'm planning to study abroad for 2 years? Yeah, we do have an option for abroad schools. I would encourage you to go to this link that I was showing you here to the rate check. If you don't have a Juno account, you can create one very easily. Check your rate. You'll input the school you're going in there, and if that school is part of the eligibility of the eligible schools, then yes, you can get a loan from using Juno. Okay, so I want to kind of double click on private loans for a few slides here. So yeah, let me just start by saying, comparing this. Okay, so federal options usually come with only one rate type, one loan term, and one repayment plan. Okay, the rate type is going to, on the federal side, is going to be always fixed. The loan term is going to be always 10, and then the repayment plan is always going to be deferred, meaning you don't pay anything while you're in school up until you graduate, and then 6 months of grace period. That's when you start paying back your federal loans. Okay. On the private side, you can play around with these three variables, right? And select fixed, variable, different loan terms, and then different repayment plans. I'll get into each one of these in just a few slides. Okay, what's a fixed rate? Well, as the name implies, it's a rate that stays the same throughout the life of the loan. Like, no matter what happens in the market, no matter what happens to your grade score, your rate's always going to be the same. Okay. The variable rate, however, is a fixed number, right, on top of the SOFR rate. The SOFR rate is an index that moves constantly, right? That index gets, moves accordingly to what central banks are doing, and monetary policies, is happening throughout the world. So the point here is that variable rates are moving as the market moves, right? They could be up, could be down. Okay. Now, I like to put this chart here just to kind of give an example of how rates can move. Okay. So actually, my own personal case, when I was in business school, 2022, rates were incredibly low, right? By the time I was graduating, geez, they started hiking rates, and then all of our loans, skyrocketed in interest rates. So we had to refinance into a fixed rate, and then it was kind of a mess, right? But the point here is that rates can move up and down. Obviously, we're in a different macro environment today than what we were back in 2022, but still the risk is there. Okay, so actually, right now, what we're seeing is basically 100% of our members select fixed versus variable, right? My recommendation is, if you're a full-time student and you're going to go to grad school for a couple of years, then my recommendation is go fixed, because that's obviously the most predictable way of predicting, so to speak, your monthly cash flow, right? How much interest you'll be accruing while you're in school, and if actually rates go down, you can refinance after school, right? So that's why we're seeing people going, for fixed these days. Now, long term, okay. I won't get into too much detail here, but the point of this slide is that keep in mind that if you're optimizing only for the cheapest interest rate, at the same time, you might find yourself with the highest monthly payment after school. Okay, take a look at the 5-year here. 6.5 interest rate, and $2,300 per monthly payment after school on a $100,000 loan, right? Whereas on the 10-year, which is only 20 basis points or 0.2% more than the 5-year, right? So it's not that big of a difference in the interest rates. It's basically $1,000 less on monthly payments. Okay. So the point of this slide is just make sure how you're optimizing, right? If you optimize solely on interest rate, keep in mind about your monthly cash flow after school, because you don't want to gotta find yourself in a situation where you cannot pay your loans after school. And at the same time, usually the difference between the 5 and the 10-year is not that big, whereas it is bigger between the 10 and the 15, for example, right? So keep those things in mind as you plan and take your loans. Okay, here's a very like an illustration. It's not a scale, obviously, of how a typical student loan timeline looks, right? So let's say you're enrolling this coming August. Let's say you're going to spend a couple of years in grad school. That means you'll be graduating roughly in May 2027. You'll have a grace period, either between 6 and 9 months. That means that roughly by February 2028 is when you start making your payments, right? That period of time while you're in school plus a grace period is known as a deferment period. Okay. Now, unless you're paying in immediate, like the repayment plan immediate or interest only, if you're not using any of those two repayment plans, then that means that you are accumulating interests while you're in school. Okay. You are accumulating interest while you're in school. That is true for federal loans, federal grad loans, and that is true for private loans. Okay. Now you're accumulating simple interests. What does that mean? Let's say you're borrowing $100,000 for in August 2025. Okay. Let's say it's a 10% interest rate to keep numbers simple. That means you're accumulating $10,000 the first 12 months. The second 12 months, you'll be accumulating again $10,000, not 11,000, right? It's not compounding. So you are accumulating $10,000 per every 12 months. And then all that money that you've accumulated is going to be added to your principal amount. And that's the amount you start paying back both principal and interest from in February 2028 in this example. Okay. Now, very briefly on this slide, the private student loan repayment plans, as I was saying, deferred, you don't pay any dollar, like nothing while you're in school, or the deferment period, right? So you don't pay anything in this period over here. There's a called fixed payments. It's usually $25 per month. The lenders offer you to pay every month while you're in school. That if you pay that, they usually offer what is known as an auto pay discount, right? So it's 0.25% discount on your rate, right? So if you're getting a 10% rate, but you're doing the fixed payments, you essentially be charged 9.75% instead of 10. Okay. What does that mean? That means that you accrue a little bit less interest while you're in that deferment period. Okay. You can also select interest only, right? Which means that basically during deferment, you're gonna have to pay the interest that you're accumulating. Okay. Lastly, you can also select immediate repayment, which means you'll be paying both principal and interest during deferment period. Honestly, this is not a very popular option, especially among full-time grad students. And I should say that the interest-only option and the immediate repayment option is not offered unless you have a cosigner. Usually, it's not offered unless you have a cosigner, because lenders want to see someone with an income to offer those two payments. And as I was saying, the most popular option here is a fix, right? Like paying $25 per month while you're in school. At least that's what we see on Juno. And after that, we'll be not paying anything while you're in school. And then obviously, interest on and immediate repayments are very, very unpopular. Okay. what are my tips for lowering your interest rate, right? Again, this is on the private market. The federal loans are going to be the same rate for everyone. You cannot change them. On the private market, you can get a lower rate following one of these steps, right? You can either add a cosigner with a strong credit profile, shop around, right? Go to hopefully Juno, place like Credible, different marketplaces where they can show you as many private loan options as possible and see for yourself who's offering you the lowest rate. And then kind of time your application, right? So what do I mean by that? I mean, if you're applying today, let's say, and you're enrolling in the fall, but your tuition is not due until, say, September, you can get approved today, lock in today's rates, right? Rates move every day, well, not every day, but every few days, every few weeks. Lenders keep changing their rates. So you can apply right now, get approved today, until even if you're starting school until September. And that way you're locking in today's rates, right? If rates go up, you'll be happy you applied today. If rates go down, then you can cancel out that application and reapply again, right? So that's what I mean by time your application. Okay. I see there's a question here. If I already have a student loan for undergrad school and I decided to go to grad school, do I have to pay undergrad loan for 6 months after I graduate? Is that loan a federal loan? If it's a federal loan, you can freeze those payments while you're in grad school. If it's a private loan, then check with your lender, right? There's some lenders out there that they do offer that option. Federal loan, yeah, you can put them on pause as you go to grad school. So what does that mean? That means you won't have to make payments while you're in school, and you will accrue interest while you're in school on those federal loans. Okay. Okay, I'm gonna touch base real quick on the changes to the federal loan policy, right? As I was saying a few moments ago, the famous Big Beautiful Bill that was signed a few weeks ago included some changes to the federal loan program. Okay, so what does that mean? That means that starting July 2026, the options for grad school from the federal government, the options, I mean the loan options, will change. Okay, so what's going to change? The grad plus is going to disappear. Okay, you no longer use the grad plus. Now, what are going to be the options? There's going to be the direct loan, also known as the unsubsidized loan option, which will allow you to borrow either up to 20,500 or up to 50,000. Okay, depends on the degree you're studying. The limit you'll get applied, right? So master's degrees, think of MBAs, their limit is going to be 20,500. Professional degrees, the limit is going to be $50,000 per year, right? Professional degrees are law, medical school, things like that, right? So the limits are going to be different, but still the grad plus is going to go away, right? So so all those people that were kind of planning to fund themselves, fund their degrees using grad plus, like up to the cost of attendance, they're not going to be capped to a lower amount. Okay. Now, if you borrowed from the federal loan, from the federal student loan before June 30th, 2026, that you can be grandfathered into the current program, right? So let me just go back to this slide. So if you borrow before June 30th, 2026, you still have access to these options. If you're enrolling in fall 2026, or you're not enrolling, but you are continuing school and you did not borrow from these federal options, then the federal grad plus is going to go away, and your limit is going to be your only loan option is going to be the federal loan subsidized loan, and your limit is going to be 20,500 or 50,000, depending on the degree you're going to. Okay. So those are the changes to the current loan program. There's a question here from Dynasty. If I take a gap year between completing undergrad graduation, and grad school, what would happen to undergrad subsidized and unsubsidized loans? Those would be put. Actually, I'm not 100% sure, Dynasty, to be honest, but I can check that for you and get back to you. Okay, so I will. Do you mind sending a note to me, please, at my email, and I will answer that for you in the next couple of hours. Sorry about that. I just don't want to give you false information here. All right. So I'm going to go ahead and just briefly touch base on Juno's current deal for grad students for 2025. Okay. So this year, Juno selected two lenders, right? From our negotiations, we selected two lenders. Lender A, right, is going to give this discounted rates for everyone who's eligible, right? That means that if you go to lender A without going from via Juno, you'll see higher rates, right? We have a rate match program attached to that lender, meaning if you find a better rate from a different lender, you'll show it to us, we'll match it and give you 1% of your loan as cashback, making that option the better one, right? It's not every lender out there, but basically 95% of lenders out there will match them. Okay. On top of that, we added a second lender to the deal this year that is not offering discounted rates, but they're offering very low rates, right? Now, it's a little bit harder to qualify for lender B, but since they were offering very low rates, we wanted to add them to our deal, right? So that's why they're there this year. Now, instead of discounted rates, what we offer when you go via Juno to this lender is you'll get 0.5% of your loan as cashback, right? As an example, that's $300 on a $60,000 loan. We have a separate deal for Texas residents. If anyone in the audience is a Texas resident, ping me, happy to touch base on this specific option. But the rates we found for Texas residents are just insane. So we like to put this in here. Kind of putting a picture on how Juno's deal looks like, right? So if you have like above 700 FICO score, we're pretty sure that the Juno option should be better than your two grad federal loan options, right? If your FICO is below 700 and you still qualify for a deal, right? Probably Juno is going to be in between the two federal loan options, right? The unsubsidized one and the grad plus one. Okay. As I was saying just a few moments ago, we have like what we call this rate match guarantee. So basically, you find a better rate somewhere else, show it to us, we'll match it, and we'll give you 1% of your loan as cashback. Now, why do we do this? We like to put this out there because we're confident that in more than 90% of cases, Juno's rate should be the best one. Now, we cannot control 100% of the cases, right? Because in some cases, lenders out there kind of, underwrite some borrowers differently, and they want to go aggressive in certain point of the year. So what we try to do here is just we want to make sure our deal is the best one possible. So that's why we negotiated this rate match with this lender, just to make sure Juno's members are seeing or getting the best out of their loans via Juno's negotiated deal. Okay. So that's pretty much it. If anyone here is looking for a private loan for this upcoming academic year, I encourage you to check us out. You can go to this link. You'll create a free account. You can check your rate using our latest deal. It's free to use. There's no fees. There's no impact to your credit score when you check rates. It's a soft credit check. And there's no hidden fees. It's basically, I know I'm biased, but it's a no-brainer to use Juno because of the benefits I just explained. And with that, I'd love to open it up for questions. Hey, Matt.
Hey, Diego. Everyone, I just want to thank you very much for very insightful webinar and just kind of going through all the different ins and outs here. I think when I was in college and signing up for loans and stuff like that, I think it would have been really beneficial for me to hear a lot of this. But you know, that
Appreciate it.
was only just a few years ago. But I did have a question here from someone, and they asked, um, when would uh, when would it be an ideal time for them to sign up for Juno if they're in that grad school exploration phase?
That's a great question. So basically, any point in time in the year is good for them to sign up. Now, if they're kind of they don't want a loan right now, I'll send a link. There's kind of a subscribe option where we will keep them updated with our negotiations each year. I will say, hey, if you need a loan this year, check out the negotiation we just you just finished, and hopefully they'll use it. So I'm gonna drop a link here for that person. Yeah, just drop your email there. We'll keep you updated with some with the negotiations, and whenever you're heading to grad school, you can use our deals. I should say that we also have something for undergrad students, right? So if this person is still in undergrad and this person needs loan for however many years left of undergrad he has or she has, we also have some options for that as well. So yeah, just want to say that.
So, well, do you have any advice or any pointers, anything else that kind of comes to mind as we kind of finish out here?
Honestly, I would encourage everyone to really shop around. I think that's key whenever you're doing, you're going for loans. Um, like yourself, like what I think of myself when I was heading to business school, like I had no idea of the ins and outs of getting a loan, and you kind of lost. And honestly, I haven't found any company out there genuinely doing an effort to educate people on what's their best option, right? And I think that's something we're very proud about. We basically take Zoom calls for free every day with dozens of students and try to guide them through their options, right? And we try to be as transparent as possible in the sense that whenever Juno is not their best option, we push them to that other option, right? And we try to explain to them the whole process and stuff, and not only related to student loans, but also personal finance. So I know I'm giving you a long answer, but the point here is shop around. If you need guidance, please don't hesitate to reach out to us. We're more than happy to jump into a call for free for 50 minutes, Zoom call one-on-one, and we'll guide you through your options.
That's fantastic. Yeah. It's good to have a resource. It's good to have access to people that understand your situation, what you're going through. So that's perfect.
Exactly. And in many cases, people are kind of, they don't want to kind of, they're afraid, so to speak, to kind of ask away, something very personal in a setup like this. So that's why we kind of make ourselves available in a one-on-one capacity, because we know everyone has like a different situation. So yeah.
Yeah. Well, that's wonderful. I want to thank you again, Diego, for joining us and sharing all this wonderful information with our members. And we had a few questions come over here and everything, so I'm glad the members got to hop in and ask you a couple of questions, and that's fantastic. If anybody does have any additional questions, I know Diego dropped his email on there. We did drop his LinkedIn here in the chat earlier. There it is again. Thank you, McKenna. And
Oh, there you
so
go.
there are plenty of ways to reach out. So if you have any questions for Diego, please feel free to reach out to him. And thank you guys for joining us. Really appreciate you hopping on here for a little bit later webinar than we typically do. But really appreciate everyone jumping on here. I hope you guys have a wonderful evening, morning, wherever you are in the world. Take care.